Ever wondered how to save on income tax legally in India? Well, you're in the right place. Today, we'll be exploring the fascinating world of income tax savings, a topic that might seem complex at first, but with a little knowledge, can be harnessed effectively. Knowing how to manage your taxes is not just about compliance. It's about understanding the system, using it to your advantage, and ultimately, saving your hard-earned money. From leveraging tax deductions on home loans, to understanding exemptions on earnings from savings accounts and NRE accounts, from money received from life insurance policies to scholarships for education, and even wedding gifts, there are myriad ways to legally save on income tax in India. So, without further ado, let's dive into our first set of 10 tips on how to save on income tax legally in India. Starting with tip number 1, did you know that you could deduct tax when taking out a home loan? That's right. If you utilize Section 80C of the Income Tax Act when structuring your house loan, you can see a substantial reduction in your taxable income. Here's the kicker. You can get a benefit of up to 1.5 lakhs on the principal amount and up to 2 lakhs on the interest paid as per Section 24. Moving on to tip number 2, let's talk about your savings account. Did you know that the interest you earn from your savings account is generally tax exempt? Up to 10,000 rupees of this interest is exempt from tax. If you're a senior citizen, this limit is raised to a whopping 50,000 rupees under Section 80 TTB. Tip number 3 is for Indian citizens who do not reside in India. If you have a non-residential external or NRE account, the interest you receive on both the accumulating and fixed deposit amounts is considered tax-free income. Let's delve into tip number 4, which is about life insurance policies. The maturity amount or bonus is completely free from income tax under Section 10 if the premium is below 10% of the sum assured. Now, if the policy was purchased before the 1st of April, 2012, the maturity amount is tax-free if the premium is 20% of the sum assured. Finally, tip number 5, scholarships for education. Under Section 10(16) of the Income Tax Act, any scholarship awarded to deserving students to help with educational expenses is exempt from income tax. This means if you're a student with a scholarship, this is one less thing to worry about. Now that we've covered the first 5 tips, let's keep the momentum going. We've got more tips coming up, so stay tuned for more ways to save on your income tax legally in India. Moving on to tip number 6, interest earned on savings accounts can also help you save on taxes. Up to 10,000 rupees of interest is usually tax-free. This applies to the total of all your savings accounts. If you're a senior citizen, this cap is increased to 50,000 rupees under Section 80 TTB. 7th, let's talk about non-resident external accounts or NRE accounts. These are held by Indian citizens who live abroad. The interest that accrues on both the fixed deposit and the accumulating amounts is considered tax-free income. Our 8th tip involves life insurance policies. Did you know that the maturity amount or bonus is entirely tax-free under Section 10 if the premium is less than 10% of the sum assured? This applies to policies purchased after the 1st of April, 2012. For policies bought before this date, the premium should be less than 20% of the sum assured for the maturity amount to be tax-free. Next, scholarships for education. According to Section 10(16) of the Income Tax Act, any scholarship granted to support a student's educational expenses is exempt from income tax. This is a great boon for those pursuing higher education. Tip number 10 is about shares and equity mutual funds. Long-term capital gains or LTCG up to 1 lakh rupees are exempt from income tax if equity mutual funds or shares are sold after being held for at least 1 year. So to recap, we've covered tax savings on interest from savings accounts and NRE accounts, life insurance policies, educational scholarships, and gains from equity mutual funds or shares. Each of these can provide significant tax savings if used wisely. Those were our next 5 tips. But don't go away yet. We've got 10 more tips coming up. So, stay tuned for more ways to save on your taxes legally and effectively. Until next time, keep your finances sharp and your tax savings sharper. Before we move on to the next tips, let's take a moment to recap what we've learned so far. We've discussed how to save on taxes through home loans, interest on savings accounts, and NRE accounts. We've looked at the tax benefits of life insurance policies and educational scholarships. We've also covered how long-term capital gains from equity mutual funds and shares can be tax-exempt. We've learned that wedding gifts from direct relatives and income from agriculture are also not taxable. Additionally, we've explored the benefits of a Hindu undivided family structure and how it can help in tax savings. Finally, we've touched on how any amount received through inheritance is tax-free in India. Each of these tips offers its own unique benefits and can help you save on your taxes legally. Now, with those tips fresh in our minds, let's move on to the next set of tips. Kicking off the second half of our list with tip number 11, did you know that income from agriculture is tax-free? That's right. The new tax regime doesn't deduct income tax from agricultural income. However, there is an indirect taxation method called the partial integration of agricultural and non-agricultural incomes, which imposes higher tax rates on non-agricultural income. Moving on to tip number 12, let's talk about Hindu undivided families, or HUFs. These are recognized as separate tax entities and are entitled to separate tax exemptions for each of their members. Plus, a basic tax exemption of 2.5 lakh rupees is provided, regardless of the HUF's residency status. Next up, at number 13, we have the money received through inheritance. Now this might surprise you, but the money you receive through a will or by being a legal heir is entirely tax-free. Yes, you heard it right. India has no inheritance tax, so everything you inherit is yours to keep without any tax deductions. For our 14th tip, let's delve into the world of wedding gifts. When it comes to gifts received from direct relatives during a wedding, they are exempt from taxation under the Income Tax Act. However, the most you can receive in gifts from friends or unrelated individuals is 50,000 rupees. Gifts that exceed this amount will be subject to the applicable tax slab. And finally, at number 15, we have income earned from shares or equity mutual funds. Long-term capital gains up to 1 lakh rupees are excluded from income tax on salary if equity mutual funds or shares are sold after being held for 1 year or longer. Now we're down to our last 5 tips. Let's make them count. Starting with tip number 16, ever thought about the tax benefits of being part of a Hindu undivided family? Hindu undivided families, or HUFs, are recognized as separate tax entities in India. This means that each member of an HUF, as well as the HUF itself, can claim separate tax exemptions. This includes a basic tax exemption of up to 2.5 lakh rupees, regardless of the HUF's residential status. Moving on to tip number 17, let's talk about inheritance. Did you know that the money you receive through a will or by being a legal heir is entirely tax-free? This is because India does not have an inheritance tax, making any amount received through inheritance exempt from income tax. Next up, tip number 18 is about agricultural income. While income from agriculture is not directly subject to income tax deduction in the new tax regime, the Income Tax Act does have an indirect taxation method for such income. It's called the partial integration of agricultural and non-agricultural incomes, and it's designed to impose higher tax rates on non-agricultural income. For our 19th tip, let's discuss wedding gifts. Once you understand what constitutes taxable income, you'll realize that any wedding gift received from direct relatives is exempt from taxation under the Income Tax Act. However, the maximum amount that can be received from friends or unrelated individuals as gifts is 50,000 rupees. Any gifts that exceed this amount will be subject to the applicable tax slab. And finally, tip number 20 deals with long-term capital gains, or LTCG. If you sell equity mutual funds or shares after holding them for a year or longer, the capital gains up to 1 lakh rupees are excluded from income tax on salary. And there you have it. 20 tips on how to save on income tax legally in India. Now that we've gone through all 20 tips, let's take a moment to recap. We started with the tax deduction you can get when taking out a home loan. By using Section 80C of the Income Tax Act, you can reduce your taxable income. This could lead to a benefit on the principal amount and the interest paid. Then we talked about earnings from interest on savings accounts. Generally, interest earned on savings accounts up to 10,000 rupees is tax exempt. For senior citizens, this cap is increased to 50,000 rupees under Section 80 TTB. Our third tip was about interest received through NRE accounts. For Indian citizens not residing in India, the interest earned on these accounts is tax-free. We also discussed money received from life insurance policies. Under certain conditions, the maturity amount or bonus can be completely free from income tax under Section 10. Our fifth tip was about scholarships for education. Any scholarship awarded to help with educational expenses is exempt from income tax under Section 10. 16. Next, we looked at the amount received from shares or equity mutual funds. Long-term capital gains up to 1 lakh rupees are excluded from income tax if kept for a year or longer. Seventh, we talked about wedding gifts. Any gift received from direct relatives is exempt from taxation. The maximum limit for gifts from friends or unrelated individuals is 50,000 rupees before tax applies. Our eighth tip was about income from agriculture, which is not subject to income tax deduction under the new tax regime. Next, we discussed the Hindu undivided family, HUF, and extra income. HUFs are recognized as separate tax entities and are entitled to separate tax exemptions. Lastly, we reviewed the amount received through inheritance. This money is entirely tax-free because India has no inheritance tax. Remember, saving on income tax is all about knowing your options and making informed decisions. Thanks for watching and stay tuned for more informative videos.